All right. Yeah. So today we are going to be talking about a couple financial reports and 8 different metrics that you can look at in your financial statements to really assess the financial health of your nonprofit. And this is even if you are not a finance person. So if you are a finance person, great. But if you're not a finance person, this is especially for you. So, like Karen said, I'm Stephanie Skryzowski. I am a nonprofit CFO. And my business is called 100 Degrees Consulting. We provide CFO and bookkeeping services to nonprofits around the world. And before I started my company about 10 years ago, I spent 10 years working inside nonprofits, most recently as the CFO of an organization that was building schools globally. And so now I work in nonprofit finance all day long. This is what I live and breathe and love. So I'm really excited to talk to you today. Okay, so like I said, we're going to share today just 2 financial statements that you should be looking at every single month. And there's a lot more, but we're going to start with just these 2 to keep it short and sweet and simple. So the first one is a comparative income statement. Now, you've probably all looked at an income statement. It's also called sometimes the statement of activities or a profit and loss or a P&L. It's all basically the same thing where we have our income at the top, followed by our expenses and our net income at the bottom, which is just revenue minus expenses, right? But the thing that I want to note that I see a lot of organizations not doing is looking at a comparative income statement. So you can see here, we are comparing one period to the prior period and showing the amount change and the percentage change. And this is important because we need to have our data sort of anchored, right? We need a comparison point so we can see, all right, are these numbers good? Are these numbers bad? I don't know if I'm not comparing them to anything else. So this is really important. This is something that your accounting system can do for you. You don't have to do any math here to add the variances or to add another period in here. And so I would love to see every single organization, when you're looking at your income statement, comparing to a prior period. The second report that we're going to talk about today, and we're going to pull the metrics from both of these, is your balance sheet. And your balance sheet is a snapshot in time, right? So this is all of your balances as of December 31st. So just again, quick refresher, you've probably all looked at a balance sheet before, but your balance sheet is your assets on the top. So this is what you own. This could be cash, receivables, fixed assets. Then your liabilities, that's what you owe, right? Any debts that you might have, whether it's accounts payable or credit cards or loans. And then your equity or your net assets at the bottom, which is just assets minus liabilities or what you own minus what you owe. And so your balance sheet is a snapshot in time of all the balances in your on your balance sheet. And then again here we have a comparative period, right? Because if I'm looking at these numbers in a vacuum for this one period of time, I have no idea if $1.2 million in our bank account, is that good? Is that bad? I do not know. So we need a comparative period here. Again, this is something your accounting system can do for you. So if we're not already running comparative financial statements, I want you all to write that down as the one thing that you are going to take away, or at least one of the things that you're going to take away today is start running comparative financial statements, not just the current period in a vacuum. Okay, so we are going to talk about 4 different metrics from the income statement and 4 metrics from the balance sheet that you can be looking at every single month to assess the financial health of your organization. And like Karen said, you will get these slides afterwards, so don't feel like you have to take a whole bunch of notes on how to calculate everything. But what I would like you to note is which metrics you think will really help you understand your financial health better, and which ones you're actually going to take action on and do something with after this call. Okay, so the first one is your revenue diversity. And this is measuring the percentage of revenue coming from each source. So we're going to be using the income statement for this. And so how we're calculating, we're just taking each revenue source divided by the total, right? So in this case, foundations and grants, 1.1 million divided by total income of 2.1 million, it's about 54%. And the reason that this is important is because we don't want all of our eggs in one basket, right? We want to make sure that we don't have any one source that is making up the vast majority of our revenue. And if we do, then we want to think about strategically, okay, well, is there something that we want to do to diversify this, right? And I think, this is very relevant right now as federal funding is changing, is being cut. We want to make sure that we don't have all of our eggs in one basket. I worked with an organization several years ago that when I came in, they had one federal grant that was making up about 75% of their total revenue. And that federal agency said, listen, we are not going to make up 3/4 of your budget anymore. You need to diversify your revenue and we're going to step out. And so they actually phased out their funding because they didn't want to make up such a large percentage of this organization's revenue. So they were forced to diversify. So this is a really important one to note. Then you could even drill further into here. Like if we were to say, okay, well, foundations and grants are making up over half of our revenue. Let's go a little bit further and let's drill into the detail behind this. How much do we have from each foundation, right? And maybe this line item is super diversified once you dig into the details, so they wouldn't necessarily have a concern. But maybe there's just one or two grants in this line item that could put this organization at risk if they were to go away. And so you can dig a little bit further there. Okay, the second metric is our revenue and expense growth. And this is just measuring our variances from the prior period. And so in this case, we're looking at the whole year of 23 compared to the whole year of 22. And we just want to see, like, how are our numbers trending? Is our revenue going up? Are expenses going up? What's happening here? So you can see that our total revenue has gone down by 23% from year to year. And our total expenses have also gone down by 22% from year to year. So in this case, okay, well, we're decreasing. Is that an area of concern? I don't know, right? We have to go a little bit deeper. But one thing I might see, say, if revenue is going down, but expenses are going up, that might be a red flag for me to kind of dig in a little deeper and figure out what's going on. So just understanding sort of how you're trending over time is super important. The third metric from the income statement is your burn rate. This is your average monthly expenses. And this is important to know because we need to know how much money is going out the door every single month, right? So to get our burn rate, we are taking our total expenses divided by the number of months and just get an average per month, right? So in this case, our total expenses of 1.8 million divided by 12 months, because we're looking at a whole period here, you get a burn rate of $158,000 a month. This is good to know, right? This is good information to have. We know that we've got 158K going out the door every single month. We need to make sure we're bringing in at least that much, right? Or that we have the reserves to cover that. There's another metric, months of cash on hand, that we'll talk about in a second, that pulls from this burn rate. So very important to know how much money is going out the door every month. Another way to calculate this is to take instead of looking at last year's numbers, look at this year's budget, right? If you take the budget for 2025, your total expense budget divided by 12, you've got your burn rate for the year. The fourth metric from our income statement is our operating margin. So in the business world, this might be called our profit margin, right? This is just measuring the percentage of revenue left over after expenses. So basically, we're taking this number down here, this 239,000. This is how much revenue minus expenses, 239,000 surplus. And we're dividing it by our total income, and we have a profit margin of 11% or an operating margin of 11%. Now, I get the question all the time, well, how much is a good operating margin? We're nonprofits. We're not supposed to have a profit. Well, not really. Just because our sort of tax status is nonprofit doesn't mean that we can't have anything left over at the end of the year, right? We need to build a cash reserve. We need to make sure that we have funds on hand for a rainy day, to help with a recession, to help if a funder goes away, right? We want to make sure that we do have something left over. So having 5 to 10% left over, I think is a good thing. We always want to make sure that we've got some kind of a surplus so that we can have a cash reserve. There's no right or wrong answer here. I think, if you had a 50% margin year over year over year, maybe your funders would start asking questions like, do you have plans for some of this money? But I think having, a 5, 10, 15% margin left over every year and building that into your budget is a really smart way to start building a cash reserve if you don't already have one. Okay, so we just talked about our income statement, right? That's revenue, that's expenses. We're going to move over and talk about 4 different metrics on our balance sheet. And remember, the balance sheet is the snapshot in time of our assets and our liabilities. So the first metric is our asset composition and just looking at the balance between very liquid assets like cash and longer term assets. And so how do we calculate this? Very similar to revenue diversity. We're just taking, each asset category, so say total bank accounts divided by our total assets. So in this case, our total bank, we've got $378,000 divided by our total assets of 426,000, and that tells us that 89% of our assets are in cash accounts, right? Is that good? Is that bad? It depends on the organization, right? There's not necessarily a right or wrong, but it's good for you to know, right? If it looks like your assets are really big, but you see it's mostly fixed assets, it's mostly equipment, or it's tied up in the prepaid expenses or something, longer term things, and you don't have a lot of cash, maybe that's something that you need to think about and focus on. So with all of these metrics, there's not necessarily a right or wrong. It's just giving you points of data to help you make strategic decisions. So the next balance sheet metric is just looking at your asset and liability growth. And that's just measuring your variances from the prior period. Same thing we looked at on the income statement. And that's why it's so important to have a comparative balance sheet, right? Because we can quickly just go over to the variance amounts and percentages and see how things are shifting over time. So in this case, let's look at, say, bank accounts. Our cash has gone down by 10% year over year. Looks like our total assets have gone down by 18%. And if you remember that our revenue had also gone down by about 23%. So this is all sort of in line, with everything sort of decreasing. So if it was me looking at this, I'd say, all right, what's happening here? Is this intentional, or do we have a problem that we need to look at as leadership, as a board? The third balance sheet metric is the quick ratio. And so this is sort of a, sort of finance accounting term, but this is really just measuring our ability to cover our debts. And so we want to make sure that we always have more assets than liabilities, right? We want to make sure that we have more of what we own than what we owe. And so in this case, we're just looking at the quick ratio takes our current assets. So under here, you see our bank accounts, our accounts receivable, that makes up our current assets, divided by our current liabilities. So in this case, it's 1.4 million divided by 222,000, our current liabilities, and our quick ratio is 6.6. So we have 6 times as many assets, current assets, as we do current liabilities, which is good. That's a very good thing, right? So we want to make sure this number is at least always 1, right? That we have at least as many assets as we do liabilities. So I know a lot of organizations that I work with have virtually no debt whatsoever. It's maybe some accounts payable and a credit card balance that they pay off every month. And other organizations have, much more significant debt. Maybe they've got some loans or a line of credit or a mortgage on a property. So it really just depends on your organization. Like I said, we're going to pick and choose the ratios that really make sense for your organization. If you're like, we don't really have any debt, then you don't need to calculate this, right? So pick and choose what works for you. And finally, the last metric that we are talking about today, and my favorite, is the months of cash on hand. And this is measuring how many months could you continue to operate with your current budget at your current level if not another dollar came in the door. And this is super important. This is basically your cash reserve, right? This is really important because as funding is shifting, as funding is being cut, as expenses are going up, we need to know how many months of cash on hand do we have at all times. This is probably like the most important metric. So if you're not calculating this one already, I really encourage you to do so. So to calculate this, we are taking from the balance sheet our total cash balance of 1.2 million, and we are dividing it by our burn rate that we calculated before, or our average monthly expenses. Remember, we saw that that was 158,000. So we're taking our total bank balance of 1.2 million divided by 158,000. This organization at this moment in time has 7.6 months of cash on hand. That's a pretty good position to be in. The average nonprofit in the US has less than 2 months of cash on hand. So it's really important to note, I calculate this for all of my clients every single month. And so we can see how things are trending. We also have a cash flow forecast where we are forecasting into the future and sort of predicting how much cash on hand we will have. So this is super important to know because we want to make sure we always have a decent cash reserve. And if you don't have one right now, if you are one of those organizations that has less than 2 months of cash on hand, building that surplus into your budget, right? Having money left over at the end of the year, that will help you get to having that cash reserve. So this one is my favorite metric. Okay, so we can use all of these metrics to help manage our expenses and keep our burn rate under control. If you are looking to make changes in your organization, you can use these metrics to really sort of craft a story about the financial health of your organization, and of course, building a plan for thriving in uncertain times, which it feels like all the times feel like uncertain times lately. And so just understanding on a deeper level the financial health of your organization can really help you make smart decisions. Okay, so before we wrap up and turn it over to questions and discussion, hopefully everybody has written down at least one or two different metrics that they are going to go calculate to understand the financial health of your org. So remember, just a refresher, our revenue diversity, revenue and expense growth, our burn rate, which is our average monthly expenses, our operating or profit margin, that's how much money or what percentage of our revenue is left over at the end of every period, every month, year, quarter, whatever. Then on the balance sheet, we have our asset composition, our asset and liability growth, the quick ratio, which is measuring our ability to pay our debts, and our months of cash on hand. So again, I hope everyone has a couple metrics written down. We want to make sure we're taking action after this. And with that, I will pass it over for some questions.